Are you confused about what is in your 401k account? Do you look at your investment statement and have just no idea what you own? Well, this video is going to dive into the basics of asset allocation. So by the end of this, you will understand what you own in your 401k or whatever investment account you have. So let's dive into it. Let's go. Let's get these basics out of the way, because if we don't cover these basics and you get further down the line in this video and you have no idea what I'm talking about, I have not been effective in this video. So portfolio, that is your collection of investments either within your 401k or whatever investment account you have. Stocks, these are going to be publicly traded equities you can buy on the market. Bonds, these are debt instruments that have been issued by a company or government to raise cash. Exchange traded funds, ETFs. This is going to be a collection of equities or bonds that is usually passively managed, meaning a company sets their strategy and just lets it do its thing. Mutual funds. This is also going to be a collection of stocks and bonds. Now, this is usually actively managed, meaning an investment manager is looking at the asset allocations and adjusting accordingly to their strategy. All right, our first asset class that we're going to cover is growth stocks. Now, this is where we're expecting the company's revenue and earnings to grow faster than the average of the market. What kind of size level do you have with growth stocks? Because you're going to have large cap growth, mid cap growth, and small cap growth. They're going to be your normal kind of growth categories. If you look at exchange traded funds, mutual funds, you'll see these usually break down into one of these three buckets. Large cap growth stocks are going to have a market capitalization over 10 billion. Market capitalization, aka market cap, is going to be the share price times the number of shares outstanding. So large cap growth is going to be 10 billion of market cap or higher. Mid cap growth is going to be in that $2 to $10 billion range of market cap. And then small is going to be anything below 2 million in market cap. So let's talk about risk. So with growth stocks, you're going to fall in that like medium to high risk category with growth stocks. The larger the size of the company, more than likely the less risky it is. The smaller the company, the more risk it usually is. Meaning large companies are more established, more likely to handle a downturn in the economy. So what are some examples of growth stocks? So large cap growth, you have your Amazons, you got your Googles. Mid cap growth would be like a Yeti, and then a small cap growth might be like a Goosehead Insurance. These are type of growth companies and where they fit within market cap. All right, next category is going to be value stocks. Now this is where you're going to look at the company and it's trading below either its intrinsic value or the business fundamentals, and you believe there is upside related to the price it's currently trading at compared to what the business economics actually look like. Much like the growth stocks, they're going to get bucketed into very similar categories. You're going to have large cap value, which is going to be your 10 billion market cap plus. Mid cap value, your 2 billion to 10 billion size market cap companies. And then your small cap value, 2 billion and below. What are some examples of stocks that fit in each bucket? So large cap value might be a Johnson & Johnson. Large company, fundamentals might be actually better than the price it's trading. Mid cap value will be like a Signature Bank where they have that 2 million to 10 million market cap. And then small cap value would be like a Bed Bath & Beyond below 2 billion in market cap. And again, with the value stocks, you're thinking there is some upside built into the stock because it's trading below its business fundamentals. That's the concept behind value stock. Now value stocks, the risk level is going to be very similar to a growth. It's going to be that medium to high risk. With value stocks, you're hoping that increase in value is going to happen because the business fundamentals are higher than the market price of that stock at the time that you're buying it. Bonds is when you issue debt instruments to the public or whoever, institutional investors, where you're trying to raise cash for either a project, an expansion, an acquisition, and it's debt. It's not equity. You have no ownership in that company. Basically, you're giving a company cash. They're going to be paying you interest over that period of time, and then once the bond is due or comes to an end, you're getting your money back. The corporate bonds, we're going to break them down into length. You're going to have short-term bonds, which are usually going to be 1 to 4 years. You're going to have intermediate bonds, which could be 1 to 15 years. If you want to make it nice and clean, 4 to 15 years. And then you have long-term bonds, which would be 15, 30, and maybe even longer than that. All right, now bonds, they're going to be low to medium risk depending on the type of company that's issuing them. And you have rating agencies that'll give it like a AAA, AA, single A, triple B. So they're going to rate the company's fundamentals, their financial, provide investors an idea of like, okay, this is a AAA, it's a very safe corporate bond, or you might get like a junk bond, which is going to pay a higher interest rate, but your risk is going to be higher of a default, and you might not get your principal back. Municipal bonds and U.S. Treasuries are going to be similar to corporate bonds, except it's not issued by a corporation, it's issued by a government, whether that's the U.S. government issuing U.S. Treasuries or municipal bonds being issued by a state or county government. These are also called muni bonds, which I'm going to refer from here on out, because if I have to say municipal anymore, I'm going to butcher it, and I don't want to do that. Muni bonds and U.S. Treasury, the one advantage you can get there is there is tax advantages depending on what type of bond it is. At certain levels, the interest that you're receiving might not be taxable at the federal or state level, depending on what you own. From a risk standpoint, a government bond is going to be safer than a corporation because you're backed by a government. Basic muni bonds are going to get broken down into two main types of bonds. They're going to be GO bonds, which are paid by tax dollars, so taxpayers are essentially paying those bonds back. And then you also have revenue bonds, which are going to be associated with a project or something that's going to generate cash flow, and that cash flow is going to pay back those bonds. Now, the risk level with muni bonds is fairly low. Now, it's not unheard of a government defaulting, but more than likely, a government's not going to default on their bonds. You could feel fairly safe with a muni bond or a U.S. Treasury. As a result of it being lower risk, typically the interest on those bonds is going to be less compared to a corporate bond. So just keep that in mind. But the tax advantage might make up for the difference in interest. So you got to look at that and balance what makes more sense to you. Do you want the tax advantage or do you want the higher interest? All right, next asset class, we're going to go to international stocks and bonds. Now I'm lumping those both together, and then you can break them out if you really wanted to, but international just means it's a non-US based company. International stocks will give you a global exposure to different countries, different continents, so you're just not fully invested in the United States. You can get global exposure to what's happening all over the world in different marketplaces, and maybe the US market's down, but the Asia market's up or the Europe market's up. It's just another way to diversify your 401k or your investment portfolio. Risk related to international stocks and bonds, it can be all the way down to a low risk level to a high, depending on what you're buying. This is where I'm suggesting, unless you're familiar with international companies, to just stick to the exchange traded funds and the mutual funds that own a basket of international stocks and bonds. All right, our next category is going to be emerging markets, which is going to be our riskiest category. These are companies that are domiciled in countries that are developing, but the economics and where they are as a country, they're just not fully developed. Their marketplace is not established like a United States or a United Kingdom. So these companies are going to be a lot riskier. However, with the risk, there's going to be a much higher upside, because as a company in an emerging market's developed, you might get on the ground floor and that thing might just blow up. But there's going to be a lot of volatility with emerging markets, so you got to ride the waves. It could be up 50% one year, it could be down 60 the next. There is a lot of volatility with emerging markets. However, it's not a bad idea to have a exposure to emerging markets. Now, you have to look at where you are in your life. Are you close to retirement? Are you not close to retirement? Because if you're close to retirement, you might want to just skip emerging markets. However, if you're like 25, that might not be a bad idea to have like a 10 or 15% allocation to emerging markets. All right, this is the last category, and it might not be in everyone's asset allocation, but I really like these type of stocks, is your dividend stocks. It's a good alternative to bonds, where you have an established company or a real estate investment trust, a REIT, that pays a high dividend. You're not expecting a ton of appreciation with the stock value, but you want to get that nice dividend either for tax reasons, or you're just looking, maybe just don't want to be in bonds and you like the idea of just getting dividends from a company. The risk level is going to be a little bit higher because you are owning equities compared to a bond, but it's going to be in that low medium because any company that's paying a high dividend is established. These are going to be your utilities. These are going to be really large companies and real estate investment trusts. Real estate investment trusts are publicly traded companies that pay out 90% of their earnings out as a dividend. That's the tax rules behind it. And the underlying assets that they own are going to be like apartment complexes, corporate buildings, multi-unit housing, whatever they particularly own. REITs are usually going to pay a very large dividend. All right, so let's try to bring asset allocation between stocks and bonds together, because you can look at your 401k, look at these 8 different categories and see what you own with your portfolio when you want to see where you are in life. If you're younger, you can ride out the waves and you want to be more than likely in equities and not too much in fixed income. As you get older, getting closer to retirement, the rule of thumb is you want to be more in fixed income and less exposure to equities. With that being said, okay, let's look at your 401k. You're going to look at it and see, okay, most 401ks are going to be invested in mutual funds. You want to look at those mutual funds and be like, all right, do I own large cap growth? Do I own large cap value? Do I own corporate bonds? Do I own muni bonds? More likely you don't own muni bonds in a 401k. Do I have international stock exposure? Do I have emerging markets exposure? There is no perfect formula, but going back to what I was saying before, look at your age, see what asset classes you're in. You might want to readjust them if you're younger to be in a little bit more, you can take on a little bit more risk. And if you're older and you see you're 100% in equities, you probably want to switch out and be a little bit more in fixed income. All right, my homework and challenge for you after watching this video to the bitter end, go look at your 401k, go look at your investment account, and see what you own. Do you own a bunch of equities? Do you own a bunch of fixed income? You now have that information to know what is in your 401k.